In this session, we are going to see the basic introduction to the cost of capital and the determination of cost of capital. Cost of capital is the return expected by the provider of the capital to the business as a compensation for their contribution to the total capital. And the provider of the capital can be basically shareholders, lenders, and the debt holders. So, it is basically what the investor expects from their investment rather than what company desires to pay. The different sources of financing are classified as below, and for each particular source, the cost criteria to calculate is different. So we have here is cost of equity, cost of preference share, cost of long-term debt, and cost of retained earning. The long-term debt will also consist of loans, debentures, and bonds. So these are the costs from different sources of finance, and with these all together, we further can calculate weighted average cost of capital. So now let's see what constitutes the cost. When an entity procures finance from either of the sources listed before, it has to pay some additional amount of money besides the principal payment. It can be interest in case of debentures, or else it can be dividend in case of equity share capital, and so on. So this additional amount of money paid is the cost of capital. We will try to understand with this example. A company issues 10% debentures to raise fund. In this situation, the cost of capital for the company is the interest, that is 10%. But the company will also have to give commission, brokerage, fees, etc. to intermediaries for issuing debentures. Now this will increase the cost of capital further above 10%. So for now, we can understand that the additional amount spent on raising fund will add up to the cost of capital. There is another concept of tax benefit, just only in case of long-term loans. Here, the interest paid to debenture holder is deductible under income tax. So the tax benefit will now reduce the cost of capital. This we will further understand with the help of Excel sheet. So here I have made a small Excel sheet format of profit and loss account. It is not exact format to what is reported by the companies, as that will be little bit confusing for some to understand. So the company here has certain revenues and incomes, and below down they have expenses, which includes cost of material, depreciation, and other things. Then after deducting these expenses with the income before, we will arrive at earnings before interest and tax. We can call it also EBIT. Then comes the finance cost for the company, which includes the interest payment on the long-term loans. Along with that, the commission brokerage fees also included in the finance cost. In this case, the company has 10% debentures, so they had to pay 10% interest and related commission brokerage fees. After deducting the finance cost of rupees 12,000 from earning before interest and tax, from that we will arrive at earning before tax. Then the company has to pay 30% taxes on the earning before tax. So after deducting the tax of 30%, get what is called earning after tax, which is 33,600. This amount is what is available for the shareholder of the company. So if the company further proposes dividend, it has to pay preference shareholder first, then to the equity shareholder from the earning after tax. So this is what basically happens. Let's take this situation where company doesn't have long-term debts. That means no interest to pay and no finance cost deduction from the earning. If that's the situation, the earning before interest and tax will have no deduction, and the full amount of 60,000 will go for taxes. So the taxes on 60,000 will be 18,000, and the earning after tax will be 42,000. Now we can see that the tax have increased more of 3,600 due to non-debt scenario. By this we can understand that the interest is considered here as an expense, which further will give tax benefit to the company. So the interest payment gives a tax benefit. So while calculating the cost for long-term debts, we have to subtract the tax benefit on the interest paid to the company.